Micron just traded through $1,000 a share, a 700% year built on memory nobody can buy. Plus 4 more stories moving the AI tape. Let's get into it. The scarcity premium in AI just moved off the GPU and onto the memory stacked next to it. Micron traded through $1,000 a share in Monday's pre-market, with early prints near 1,089, up about 11% on the day, roughly 240% year-to-date, and 700% over 12 months, a $1.2 trillion market cap. This is not sentiment. HBM and DRAM output is contracted out through 2027, and SanDisk's guidance last week killed the last live bear argument that bit growth would outrun demand. The whole complex moved together. SK Hynix and Western Digital both up more than 7%, SanDisk up 14%. The bear case? Memories is the most cyclical business in semis, and sell-side targets running from $1,100 to $2,200 means nobody actually knows what this is worth. Watch TSMC. It closed up just 0.21%. If the foundry stays flat while memory rips, the market is repricing memory scarcity alone, not the whole accelerator bill of materials. Stripe just bought the toll booth sitting between every developer and OpenAI, Anthropic and Google. The payments company finalized a deal for OpenRouter at more than $7 billion, roughly 5 times the $1.3 billion valuation investors assigned the AI gateway in its Series B in May, 3 months ago. OpenRouter routes about 8 million developers across more than 400 models and moved roughly 1.5 quadrillion tokens in the past year. The strategic read is that the durable margin in AI may not sit with the labs at all, but with whoever sits between them and the buyer. Stripe now owns the payment rail and the model selection rail, plus a real-time view of which models are actually winning enterprise spend. The bear case, a 5 times markup in 1 quarter for a business whose switching cost is a config change, and the labs can route around it with direct enterprise contracts. Which is exactly what the next story is about. If Anthropic's enterprise revenue keeps compounding direct, the gateway's take rate is the first thing to compress. Anthropic just cleared the bar. OpenAI hasn't, weeks before both of them faced the IPO window. Preliminary second quarter revenue came in and above $11.5 billion, against $787 million in the same quarter of 2025. A 14-fold year, and more than double the $4.73 billion it booked in the first quarter. The bigger number is smaller. Positive adjusted operating income, the first quarter any frontier lab has shown one, reported near $559 million. For a sector whose central bear case is that model providers are structurally unprofitable, that reframes the entire argument. The bear case. These figures are preliminary and could be revised. And the word adjusted is doing real work. An adjusted profit at this burn rate is an accounting posture, not free cash flow. The next read is the final numbers into the fall IPO window. Confirmed operating income, and every lab gets repriced. Revised down, and the unprofitability thesis comes straight back. Higgsfield raised $400 million, led by DST Global at a $5.4 billion valuation, roughly 4 times its $1.3 billion mark in January, 8 months ago. The number underneath is the one that matters. Annualized revenue went from $20 million a year ago to $700 million, and enterprise customers moved from under a quarter of revenue in January to the majority today. That mix shift is the whole thesis. Generative video has been dismissed as a consumer novelty. A 35 times revenue year driven by enterprise conversion is the first hard evidence that marketing and media budgets are actually reallocating. Goldman Sachs Alternatives and Intel Capital both took part. The bear case. Annualized revenue is a run rate snapshot, not booked revenue, and the underlying models are commoditizing fast. Google is already halving the price of its cheap tier. The signal to watch is the next round. if it prices without an updated enterprise share disclosure. The mix shift stalled. Michael Burry is short Oracle and Nebius on a single claim. The money the hyperscalers spend with NVIDIA is circling back as NVIDIA's revenue, and roughly $3 trillion of the bill isn't on anyone's balance sheet. The breakdown is about $1.2 trillion in leases that have not yet commenced, plus $1.9 trillion in purchase commitments, against reported on-balance sheet debt closer to $1.35 trillion. So headline leverage understates true leverage by about half. Alphabet disclosed $811 billion in commitments as of June 30th, up from $332 billion a quarter earlier, and posted its first negative free cash flow quarter as a public company. Meta's free cash flow fell 91%. The bear case on the bear case. Commitments are not debt. The consolidated $3 trillion framing is carried by aggregators, and Burry has been early before. The next read is NVIDIA on August 26th, with consensus clustered between 92 and 95 billion. If that guidance leans on the same handful of hyperscaler names, the circular financing argument gets much harder to dismiss, including for the memory names that just repriced on it. One through line today: the market is paying up for the physical choke point, memory, and for the toll booths above the labs, while $3 trillion of the bill for it sits in filing footnotes. NVIDIA on the 26th settles the argument. Subscribe for the daily read. This is the Daily Alpha.